Thanks for joining me. I'll just start by giving you guys a little bit of background on me and my trading here before we dive into our main topic. So I began trading online in the mid-1990s, really right when the markets were first going online. There wasn't a lot out there as far as education went with technical analysis. So I'm pretty much a self-taught trader when it comes to TA. Um, I started teaching market analysis almost from the beginning of when I started trading, and it wasn't really intentional. I just started a website as basically kind of like a blog for like personal accountability and sharing what I was doing and what I was noticing and mistakes I was making and things I was watching. And it got attention from some of like the major players out there that were doing like expos and things like that. They were this was before the money show, and they asked me to start coming in and teaching some of the beginner stuff. And I was already doing a lot of the work. They asked me to do a newsletter. I was already doing the work myself. So I'm like, okay, sure, I'll do it. And I found that the fact that I was teaching in addition to trading actually made my trading so much better because I was held accountable. And I think that's a big thing. I was talking with some of my traders here today is accountability. I think a lot of us as traders, we aren't really accountable. I mean, the only people we have to be accountable to are ourselves and maybe our family members. But how many of you really put the time in to study each and every trade that you're taking, that you look for pros and cons in every single setup? If something works 10 times and fails 3 times, what do you do to try to figure out why it failed the 3 times? Or do you just accept the fact that it works 10 times and will fail 3 times? I never liked to accept that. I wanted to know why. I always wanted to know why. I was always questioning and trying to figure things out. So when I basically developed my system of market analysis, I started looking not so much for like a pattern, like a bull flag, but what were components that went into each of these patterns? Why is it that these bull flags are working and these aren't working? What is going on behind the scenes? What are the details in that bull flag that are affecting its odds one way or the other? And so I developed what I call my building blocks of price development. And this is what you guys have seen me teach at the expos. This is what I've talked about. I wrote for Jim Cramer's site on TheStreet.com for Real Money Pro for a number of years. And I was always referencing these building blocks of price development. And these are in and of themselves simple ideas, things like trend placement, trend development, momentum, volume, support and resistance levels, and time development. So these are all really simple ideas, but they all have to work together to create these patterns and to affect what your risk is on every pattern. So I want to share with you guys today some of the stuff that I do with Fibonacci. One of the things you're going to notice very quickly is that I don't generally have any indicators on my charts. That's because I didn't learn trading with indicators. I think from the very beginning, I started out with like simple moving averages, but over time, I didn't even look at those. And don't get me wrong, you guys, there's nothing wrong with using indicators. Indicators can be great as confirmation tools, and they can also tell you when something's not quite ready or not quite right. But I've found that so often it's hard for traders to see the underlying price development in the market because they're so hyper focused on indicators and not necessarily taking enough time to learn the ins and outs of the indicators that they're using. So if you're going to use an indicator, use it for the long haul so that you know when it's not valid. And it doesn't clutter up so you can't see the underlying picture, you know? So that's basic some advice there as we get started. But what I want to share with you today are just two very simple Fibonacci tools that you can use. They're going to help you with your timing. They're going to be a couple of those, they're kind of like crutches, you know? Think of indicators as crutches. They're helping you out along the way. And you don't want to use your crutch upside down. You know, you don't want the pointy bottom part stuck under your armpit jabbing you with the armpit side on the ground. You want to use your crutches properly, and as long as you're using them properly, they can really help you out. So Fibonacci is one of those crutches, and it's one of the very few crutches that I introduce to my traders when they're getting started, because it's something that doesn't really change. No matter what market you're using, what time frame you're using, anything like that, it doesn't matter. You're still going to be able to use them. And Fibonacci is very lenient, meaning you can draw your levels from totally different levels that somebody else has. And they might be labeled differently. You might have a 76.4% fib level while somebody else has a 100% fib level, because you use different starting points, but they often have levels that all converge together. And so that's the really cool thing about them. I'm not sure how many of you guys have heard other fib talks here today, but I'm going to start kind of a little bit basic and go into some practical applications so you guys can see how I used it on a trade here today. So the main thing with trading is that you need to be able to build confidence in your system. I'm doing psychology week this week with my traders, and we started it last week. And the one thing that I said from the very beginning last Monday is that you can't meditate your way into a good trading system. You can't go and become an awesome trader just because you start your day meditating or doing yoga. You have to put in the works to learn a system to begin with. It's like becoming a surgeon. You know, you can go into med school, great ambition, you guys, and you're not going to be able to meditate your way into becoming a great surgeon. You got to put in the work to learn the system. And you start with the basics. You know, you think of your college level courses or even high school or whatever. You start with like class 101. Next year it's 201. Next year it's 301. Next year it's 401. You're working your way up and you're building upon the knowledge that you learn at those base levels and expanding from there. And the Fibonacci tools I'm going to share with you today are things you can apply from levels, 101 to 201 to 301, and then you can keep building upon them. Over time, what you're going to find is that you're not even going to have to put them on your charts because you're already going to be mentally thinking of these levels as support and resistance levels. So let me go in and share with you guys some of what I mean here. So first of all, we need to be able to trust our instincts in trading. We need to be able to make split-second decisions a lot of times. But to trust those instincts, we need to hone those instincts. And we do that by having a good system to begin with and really practicing and applying that system. Indicators are a great way to help you at those initial stages. So indicators based on Fibonacci are really some of the most accurate indicators out there, and that's why they're the only ones that I teach my traders these days. I'll do volume to an extent, but really fibs are the main thing that I will teach them, and I don't make it difficult. We're not getting into a lot of arcs and all kinds of different things with fib levels. We're just starting out with some of the basics. For those of you that don't know Fibonacci, it is basically a series in mathematics where every new number in a Fibonacci sequence is the sum of the two previous numbers. And what this does is that when you look at the ratios between these numbers, there's a lot of different mathematical ratios that are going to come into play where this is basically continuous, and this is where our numbers come from. So we often use 23.6, 38.2, 50%, 61.8%, 76.4% when we're using Fibonacci-based indicators. And those are just based upon mathematical relationships between each of the numbers in that Fibonacci sequence. So there's a ton of information out there that you can dive into if you want to learn more about Fibonacci, its background and such, but you really don't have to know it in order to use it in the markets. And I will tell you, I am a skeptic about pretty much everything. So when it comes to indicators in the market, Fibonacci was no exception. I don't even know how much that I really, back it as far as the world in general. I came from a background in the arts, so I was already really well familiar with Fibonacci ratios and that sort of thing. But I can tell you it works in the markets because I've studied it and I've seen it every single day, day in, day out. There's no exceptions. But like every indicator, there's times you have to ignore Fibonacci, and there's times where you have to pay really close attention to it. So we're going to talk about a couple of different types of Fibonacci here today. I'm going to talk about Fibonacci retracements. So for example, let's go look at, I'm going to pull up the dollar yen here. I've got a lot of my charts kind of all stacked up here, so I'm going to make sure I grab one. So one of the core setups that I like to trade is a breakout or just a simple continuation pattern. Thanks, Jerry. And so one of the things that I look for on a continuation pattern is I want to see a main impulse move. And an impulse move in the market, you guys, is, let me grab a pen here. It's just a primary directional trend move with strong momentum. So this is an impulse move here on the downside. And so when you're looking for a continuation pattern coming out of a zone of congestion, this impulse wave is what I'm going to first use to go and apply some of these Fibonacci tools to. So a Fibonacci retracement level, this is on NinjaTrader, but all charting platforms are pretty much the same. You go down to Fibonacci retracement. I want to hook this up to the high here and then go down to the low. And what that's going to do is it's going to apply what will become these resistance levels as things pull back in this congestion. Now, with a continuation pattern, there's some things that I want to watch for. I want to watch for pullbacks that ideally hit the 23.6% retracement, 38.2% retracement, but stay underneath that 50% retracement. The reason for this is that if I'm taking a breakout where it's pulled back to 50% retracement, just again using really simple Fibonacci retracement levels here, if it's pulled back to 50%, what happens is all of this support back here can end up being support again. So it can have a harder time doing a strong continuation break as easily. You're going to find plenty of exceptions to this, but what I want you to focus on today is not the exceptions, focus on the rules. So remember, we're in Fibonacci 101 or Fibonacci 201. So what you want to focus on is that the strongest pullbacks for continuation will have, for example, pullback to 23.6, might make it up here to 38.2%, then base again into 23.6%. And what do you guys see happening in here? What's kind of a core pattern that's forming in there that you might already be very familiar with when it comes to technical analysis? Some of my traders would call it a scary ghost, but what's a more traditional term for it, you guys? Head and shoulders, right? Now this doesn't look like a perfect head and shoulders, right? Because you've got a lower low here. A perfect head and shoulders isn't going to have a lower low, but we want to focus on the basics and the core elements here. So when we look at retracement levels, if this comes up to closer to that 50%, it's easier for it to hold these previous lows here. If this had a head over here where it pulled up and maybe did like a 2-wave correction, only came in to 38.2%, it's easier to break it down faster. So notice that the first high here holds 23.6. This one, for the most part, is at 38.2. And then this one over here, 23.6. These are really good fib levels, showing me that that has a really good potential for a breakdown, especially the fact that when this pulled down over here, you guys, look at what happens over here. I'm going to clear this fib level. I want to show this one to you here. So if we go again from that high, we're going to take that head pattern there, and we go down from the low. Look at where this is holding. It comes up, it pops up, it hits that 50% retracement. So when it comes back down, it holds that next low. Here's the second wave up. So again, since that second wave up is also still at that 50% retracement, previous low serves as support again. Third one, 38.2. We've got that baby head and shoulders in here, or scary ghost pattern. So we've got that baby forming in there, and it's also holding with those levels. So this could have even gone into another base here that would have helped you out. The nice thing about these is that when we're looking for a trade setup on something like this, once it starts to pull off of that 50% retracement, the fact that it didn't go further than that and then goes and puts in that lower high here, it adds the potential for a strong momentum breakdown. So this is just one of the Fibonacci tools that we use, and we use it in relationship to the continuation patterns. So you again want a correction holds under 50% in order for it to have a strong breakdown as a continuation, and I'm basing it upon the first impulse wave here, the first impulse wave. This is actually a pattern in here too. It's called a megaphone. And as a continuation megaphone, this would be 0.1, 0.2, 0.3, 0.4, and 0.4 is another type of continuation pattern too. So my traders will see that in this trade. So this is our dollar yen here. This is just on the 240-minute chart. Now, let me go and I'm going to show you lots of examples here as we go through today, and more examples of how we can apply these fib levels as well. But let me show you the next type of tool that we can use with this, and that is the Fibonacci extension. So on this, I usually use a 3-point extension. Now there's two types of extensions or expansions, and depending upon the trading system you're on, they might label them differently. So for example here, if we look at, let's see, go back to my yen chart. Where is it hiding in there? Here we go. So if we look at this chart, for example, some of you guys might be familiar with this as an extension where here is our retracement, and then these are a type of extension or expansion, and it's basically the same fib levels, but then they're projected on either side. So I will use these sometimes, like for example, if this is the original move down here, let me clear this. A lot of times you might find, for example, that this goes and does like a 2-wave move down, hits the negative 23.6 and holds off of that. So you can find things that will go and do that sort of thing too and serve as, you know, further continuations. So you want to leave those levels on there. They can be very helpful, but another type of extension is a 3-point extension or 3-point expansion. And again, different platforms refer to these differently. And what that is is that's used to establish target levels. So when we are using a Fibonacci extension, I'm going to go from the high to low of that main impulse move, and then look at where this impulse move starts over here. If you go and then apply it to that move, and we can really go here because this is where it's starting to do the breakdown with the two-wave correction there. We can use that to help us establish target levels and what to look for. And now I mentioned here that you can have some leniency in how you establish this. So for example, I usually use the second high in a congestion for the breakdown for the impulse wave. But if you looked at it from like the last impulse wave from where that started, what you're still going to find is that there's zones based upon that level where you still get things stalling too. So you can still see some of the support levels based on both of those ways that you would do it. Basically, what I want to do though is I want to look at this full impulse wave move down here. And so that's going to help give me like the bigger target. And in this case, what I usually go for is that almost all of the time, as long as this momentum on the breakout is the same pace as the momentum over here on this first impulse wave, I can get that 100% extension pretty darn close to that 100% extension. If the momentum shifts, then my target level might shift. And I'm going to show that to you here as we go forward. But this is a really good tool to help you out. And what's also cool about this, you guys, is that look at when this pulls back. So when we get retracements back into this zone, if that momentum is average to stronger than average, I'm often looking for the 38.2 or the 23.6 as a target level for the reversal on the way back up too. And I'll just keep these fib levels on. So a lot of times Fibonacci retracement levels that I will put on like larger time frames, they might go back and forth between that range, past that range, come back to the range, and they will still be holding days and weeks later. You'll still be getting clusters of highs and lows at those levels. So that's what makes this a really strong type of support or resistance. And obviously, the more we combine it with other types of support or resistance, the stronger they're going to be. So for example, you know, if this zone here also happens to have congestion over here in the past, or a previous low zone over there in the past, that's going to make it even stronger too. So these are really simple tools that you guys can take and you can apply to your trading, that it doesn't take a lot of skill set to start to work with them and start to use them. Now, here's where things start to get trickier, and that's when we add in momentum. And momentum, you guys, is just the rate of change that happens in a security. So what we're looking at, for example, here, this is a template that I've used for, I don't know, 2 decades or so probably. I think I originally made this template around the end of the late 1990s, and there's been absolutely zero reason to change it whatsoever. Basically, what you're looking at is that momentum is your rate of change. So here, the momentum is pretty comparable. You know, the move up before A and then B here is about the same. So it's normal for that to have 100% extension. But look at here, C to D. Trend is getting exhausted and the momentum is changing. We're seeing a shift in momentum. This is what happened yesterday on the S&P 500. Let me see if I have got the chart up of the S&P here. Depends on what I've got in the background. Ooh, my charts are doing a waiting game for some reason there. There we go. So this is what we saw happening yesterday on the S&P 500. Go to some larger time frames here. right in here. So see how we have this shift happening up here. It's coming up and the momentum is changing here. So this actually triggered a type of short pattern. Donna, she's probably in class here right now. She caught this and posted this to our traders. This is one type of reversal strategy, and it's just based upon that subtle shift in momentum, you guys. So what we're seeing is that it was right here. And what that does is it can help shift the momentum even further. So this range here, very similar to what we saw happening on the dollar yen, except in this case, we only have a two-wave move. Now, if this had held under 50% retracement of E, it held under there, had averaged slightly stronger than average momentum on E, held under 50% retracement, it's easy for that to go and give a pretty strong breakdown and strong continuation. Now, if the, what you'll see here too is that from F to I really, we have a couple of different things where momentum is changing. So what I mean by that, you guys, is that if we connect these highs and we connect these lows, and we connect the highs and lows of the channel over here, look at what's happening. This is starting to trade towards the lower end of that channel. Our overall momentum here is now slower than the momentum was here. That's what's allowing this to develop into something that can have a really strong breakdown. So when we are looking at continuation moves, if you're looking at a breakdown or breakout type of strategy, if that momentum is as strong or stronger than it was over here, you might not only get the 100% extension, but you might get substantially bigger than that. So your 100% might be your first main target, but you can get way more out of it if you add in that bigger momentum shift going into the breakouts. So here, example, this is just a break on the upside. Here's the break on the downside. So when the momentum is similar, you guys, then 100% measured move is the typical target on a continuation strategy. But there's a lot of situations where we can get more than 100% or we'll end up getting less than 100%. So I've been trading gold a lot. We've actually been long gold for quite a while here on the monthly time frames, but I'm going to show you 3 different ways that momentum can impact our continuation plays here. So for example, we've got a nice shift in momentum down here. Look at the little head and shoulders, inverse head and shoulders in this case. So you've got that nice move. Now notice here, what's interesting is this actually gives you more than a 50% pullback, right? But what did I tell you guys earlier? I said if it holds under 50% or above 50% in this case, that's actually better. And yet here's an exception to that. So there are exceptions to it. So when we're talking about the core basic idea, when you're learning a new strategy, focus on the core. Focus on what happens most of the time and then start to learn the exceptions. This is a beautiful exception, you guys. We had a nice, slower momentum pullback after the stronger shift up here. And then it had a little baby shift in momentum here to help really fuel that breakout and get it going. But yeah, this did pull back more than 50%. This one did not. You can see it had the stronger momentum move, went into the trading range, gave the break, didn't pull back 50% or more than 50%. That can help give you a stronger probability. On this case here on the way down, you can see this came back up right into that 50% zone. Kind of made it a little bit more iffy. had strong downside here, so it was able to get going, but this extreme momentum here made it harder for it to give as strong of a move. So extreme momentum like this means that a continuation move has a harder time getting going. If it's an average momentum move, your breakdown is going to have an easier time getting going. And there's even times on reversal patterns where you'll get a rounding off at a high or a rounding off at a low, and you'll get something where it'll come up, it'll kind of have a shallow pullback, an even shallower move like that, and then bam, you get momentum going really quickly. So in this case, you can see that if this is our high here, this comes up here and it comes more than that 50%. So it's similar to what we had happening down here. It came more than 50% and it was able to have even stronger momentum, but it was because it had already started to round and shift momentum. So that helped it really get going. So I'm not just looking at Fibonacci here, you guys. I'm also using Fibonacci with momentum to determine what we're looking at for target levels. So on this, as a breakout, we've got a 2F correction. It's kind of tilted to the upside a little bit. There's a little shallower breakout right in here. It's kind of hard to see on this, but there's a little small breakout that gives better timing right in here. You guys see that little pause? So it's like a little one of these that helps trigger that bigger breakout. So if you were just looking at like a 1-to-1 ratio, your target would be right here. But since it's also breaking this bigger move, you got this bigger target up here. And this was a trade that Scott and I, was this one you were in, Scott? Anyways, I think this was this one Scott was in too. But we took one in gold that was off of the low this morning, and it only had a little teeny tiny move. This one was the overnight one from last night, but it had a little teeny tiny shift in momentum there. Helped propel that bigger momentum here. So this on the continuation though, overall continuation momentum, very similar to what it was here. So it helped time that 100% as a target level, really clean, clear target level. Now, when momentum changes though, you guys, and the breakout is a little bit different, things can change. First, I'm going to show you an NQ tick chart though, before I go to show you some different ones. I like mixing in traits that we've had recently, especially like today and yesterday, and so you can actually see how they're being applied right now. This is one of my traders, Harvey, took, and I think Ram took this as well. We had a breakdown strategy here. And what's interesting is that it's not the core breakdown. So I'm going to show you the Fibonacci retracement portion. Here's the impulse move on the downside. And what do you guys see happening here when this is pulling up? What's our resistance levels you guys are seeing? Yeah, it held that 38.2% for a retracement, which is great. So what we want to see is ideally with continuation strategies, one of the core continuation strategies you guys can learn and study is one that I call an avalanche. And it's just a breakout strategy. And it's something that comes off of a high, goes into your trading range, breaks that range, and is an avalanche. So think of it as a mountaintop here. This is your peak up here. Sometimes that might be the head of Head and Shoulders. It might be a rounded peak like an inverse cup with handle. We don't really care about that so much. We care about what goes on in here. And the core pattern has two waves of correction, 1 and 2, and then it breaks down. So you'll see up, up, break down. Now sometimes it ends up being a little head and shoulders, like we saw a couple minutes ago, but that's the general gist of things. And so when this pulled up, a lot of times these smaller moves will also have two waves in them. So for example, this move to the shoulder would have two waves, the move to the head would have two waves. And so this could be the first breakdown for a continuation move where we go and it gets to 100%. Or since it's still pretty fast, it might need to base out a second time and go and give the continuation before it gets to that 100% extension. So when this breaks down here, what you guys will notice is that the momentum is really similar to over here, but it has a problem. It only gets to what is the negative 23.6% for the retracement, and then if I put the extension on here, I'm going to remove the retracement one because that's kind of getting confused, you guys. So let me add the extension here. And so notice this only gets to like the 61.8. So this is your 61.8% extension here, but the momentum is still really similar to over here. What that tells me is that maybe I'm just too early. So I know for a fact Harvey, one of my traders, was in this one from the early one, and then he added into it as it offered the continuation for the longer base. One of the ways you can tell if you're too early is using a type of basically a type of measurement based upon prior zones of congestion. So for example, look at this congestion here but at the highs and how long that congestion took before we got a break of that congestion here. So if you take that same amount of time, well, when this tried to break here, it was about halfway of that previous zone of congestion. And what that means is that it might need to go and do somewhat longer congestion before it goes and turns. And you can even look at some previous examples of corrections too. So here's a good two-wave correction. Look at how long time development wise that two-wave correction took compared to over here. And this can give you an idea of, hey, you know what, maybe I'm a little bit too early. I'm not going to let that panic me that it only went to 61.8 and then pulls back into the congestion, because I've seen previous corrections take that same amount of time. And whereas this could be just a short little correction, look at how long it took this entire bottom here to form. It starts here, it breaks out to reverse over here. So this is about that same amount of time as this one. But then it comes and pulls back in, so the entire correction ends up being a double bottom here before it's able to turn around. So very similar time corrections going on here tell me that I might be a little bit early, but I'm not going to panic if it doesn't hit that 100% extension. So what that can do is it can be that this is your first wave of correction, this is your second wave of correction. So really, your two-wave correction is just tilted to the downside. So typical two-wave correction might look like this and go, but sometimes it looks like this and goes. And paying attention to those Fibonacci extension levels and where things stall based upon the momentum into those levels can help you determine if it really has that next leg down. So for example, if this middle leg here, if that was not as fast or faster than the first wave down, it would be easier for that to go and turn around to do like an inverse head and shoulders. So that momentum has to be as fast as that first momentum in order for me to have good confidence that that's going to go and give me a bigger continuation. And then on that bigger continuation, you can use two different types of fib extensions again. So the one that I left on here what you guys can see is that it gave support here at 123.6. But what I will usually do is if there's a two-wave correction, I will go and I will hook that up to the second high. I don't have my snap mode on, but I'll go and hook that up to the second high. That gives me a better target level as long as this momentum for that impulse wave continues. Because remember what I said, I'm looking at comparing impulse waves. So what I really want to see is this impulse wave down here compared to that impulse wave down here. And so he added in here. I think he took some partials off at some earlier support, but he added back in, nailed that 100% target level. And I'm talking to you guys regarding examples from my traders here because you can go in and see these trades from them where it just shows you how well these things are in terms of like their teachability and how well you can incorporate them over time, and that they really are very repetitive and you can really rely on them. It's not something where there's a ton of subjectivity involved. It might feel subjective to start with because you might be looking at tons of different variations or versions of stuff. But it's like learning the English language. The English language, once you know it well, there's not much subjectivity as far as what meanings of words are, what order things go in. You're going to know it. But to begin with, I'm teaching my kid here to read right now. So if I say something sounds like a certain sound in one spot, but then he's like, hey, but why does it sound different here? It's the same spot. Well, there's some differences, but once you learn those don't change either. So that's a good way to think about technical analysis is you start to learn all of the intricate details, but you got to have that starting point to begin with. So here's a trade that I had at the end of the day. And this was on gold. I'm showing you guys the micro here because I know a lot of you guys are trading the micro contracts. And what we had here was, again, a phoenix. It's the opposite of that avalanche. You can see the rounding over here. So it's kind of shifting momentum already. Notice the low here. It only pulls back about 50%. And then the next correction over here is even higher. It's probably around the 23.6. I didn't put the Fibonacci retracement levels on here, but it's probably around 23.6%. Now, I actually built into this a little bit early, but remember what I showed you guys on the NASDAQ, how sometimes the setup might be a little bit early? I started building into it here. And I realized that could be a little bit early based upon some of the previous corrections that were happening. They were longer. So it didn't faze me that this only did a measured move here to here. I did take some of the trade off when it didn't go right away, but then I added back in on that smaller little breakout over here. And at this point, I was able to move my stop on everything to under this low too. And see how that almost doubles it out? That's a key. If something doesn't go here, but the momentum is as strong as it is over here, and it doesn't hit that 100% right away, that doesn't tell me that the setup is wrong. It just tells me I was probably too early. And most of the time these days I know when that's a probability or a possibility that I'm too early, but I like to still take it there anyway or start to build into a position there anyway. And then I'll use the secondary pullback that's a little bit longer to help give me a better setup. And look at the volume, you guys. This scares off a lot of traders, especially on gold, because when the volume drops to this, it's like doing nothing. It's a little bit different lately because it's just been, you know, so much activity on gold, but that is something that really can scare a lot of people, but I love it. When you're in a trading range and you've got this pulling back into support, like the 23.6%, and especially if you have slower two-wave momentum into that support or rounding off like little baby head and shoulders under here, that's beautiful, you guys. And then your target level is the 100% extension. Well, on gold, we are very extended here on the daily chart. So I didn't expect that I would get 100%. When I don't aim for 100%, I aim for 76.4 because that is the next most probable level where if the momentum is slower, I can expect that to be my target level. So what I did was I went and I added the extensions on here. So I took part off here, which is actually 61.8% extension on the bigger one, but I used the smaller measured move to help me out. And you'll notice that's about where momentum started to shift. And then I got out of the rest of the trade at the 76.4% extension. And look at this entire momentum here. It's slower. So if the overall momentum slows, meaning I end up with a bigger correction in here at a halfway point than I did on this upside move, then I can adjust my target level to 76.4 and have a pretty good probability of that being where it holds. Notice I did get more aggressive in taking some off here because it had that measured move right here. And so because of the larger time frame, made me a little bit more nervous that it might not go as far. Now we've got the opposite end of the spectrum, you guys. We've got that monthly and weekly time frame on gold. So this is coming off of a very big rounded bottom here on the monthly time frame. And what you can see is, pretty average momentum on the upside. Here's the two-wave correction. Second wave of correction was slower than the first. Now, notice the first buy setup here comes off of that two-way pullback. This is holding in the upper 50%. If we look at some of these other zones of correction, there was the possibility that it could have come up here based and continued, just like what we saw at the end of the day here on gold. So I was keeping that possibility in mind. So what you guys saw me do with gold over the last year was I just built into a longer term position, but I used smaller setups like these, those smaller breakout setups, to really put on most of the positions and build into the position. And the momentum here ends up going out of this much stronger than it was coming into it. So that means that here's the 100% level, and yeah, it stalled at that 100% level, but overall, it was able to break out and go way past that level. And one of the key features of it is that this smaller breakout is part of a bigger breakout here too. So this had a slower move too here. It ended up being way larger than 100% there too. But that momentum is really what can help propel us. So you want to watch those when you're looking at target levels, and especially if momentum is slower, you guys, like it was back in here. So even that 61.8%, we saw some stall at it. Look at how it stalled a little bit at the 38.2%. In something that goes to 100%, usually that breakout move is going to make it to 61.8. So the fact that that stalled at 38.2, that alone tells me that it's going to have a harder time making it to 100%. So if this had popped up here to 61.8, better chance it would make it up all the way to 100%, even if it pulled back to 23.6 first. So it could have gone up to here, here, and there. And you'll notice that this would then be a two-wave measured move there, just like what I did for my management, but bigger. So these tools are really simple to use, but they're priceless. They're going to help you out so much as far as being able to get the most out of all of these. Now, Fibonacci indicators, you guys, like I said, they can be used all trading environments. They're really useful in establishing target levels, but things like Fibonacci fans can help you with establishing time development too. So they can help you understand if something is too early for a breakout? Are you getting into this in something that might take a lot longer to speak before it gives you a bigger break? It can help you with target levels, even just the Fibonacci fans. For those of you that want to learn more about my system of market analysis, I have a boot camp that I put together that focuses upon Fibonacci, and there are 4 weeks in it. It's about 14 hours or so, and it goes through all of my core strategies. So what it does is it starts with week 1. It tells you about the Fibonacci tools that I use and how to use them, different quirks of when to apply them, when not to apply them. Then it goes into trading the trend changes. So those are going to be like those first continuation moves, things like head and shoulders or cup with handles, but we call them the Phoenix and the Avalanche. And it's going to help you determine, hey, are you going to just get like a one-wave continuation, or is this something that's going to be a major trend turnaround? What are the individual building blocks within each of those patterns to help you get the strongest pattern possible? So little hints like, hey, how far does that pullback happen for the retracement? That's one of the little clues, but it's only a little part of that picture. Week 3 goes into continuation strategies. Week 4 goes into pivot strategies. So these are timing those absolute highs and lows that you guys see me post on like Instagram and like in the room, or, you know, when I'm doing my live classes and you guys are seeing, you know, when we're doing live market analysis, a lot of those absolute pivot highs and lows. So you guys can pick this up at Fibs Rock, ToniHansen.com/Fibs Rock. It's usually $297. I have it available for you guys for $149. And the thing that is important with this course is that I now require it to be in our mentoring group, which is League of Traders. And League of Traders meets every single day for an hour. Every single week we focus on one topic. So this week, for example, we're doing psychology, but it's not just psychology, it's psychology within the context of trades. So I even shared with you guys how I blew up a futures account once. It wasn't pretty, but what did I do? How did that happen in the first place? Basically, I got overconfident because I was rocking it in stocks, got overconfident and wasn't sticking to my rules. And how did I make a comeback from that? You know, how did I recover psychologically and emotionally to be able to go back to doing really well and refocusing? And we look at it in the context of actual trades and examples in the market. So every single session we're using live market examples. So you not only get to see how the concepts in the top 3 strategies using Fibonacci play out from a textbook standpoint, but you also get to see all of the variations and my thinking as something is unfolding and developing. And you get to see other traders learning to apply it themselves as well, and me helping them with their trades. So I highly recommend you guys do the 3 strategies for Fibonacci, and it basically takes you through the main core trading strategies that I use. Are my numbers and strategies good for Forex as well? Absolutely. So I trade stocks, Forex, and futures, all time frames, you guys. And mostly you're going to find a lot of examples in League of Traders from the futures markets, just because I drill down to smaller time frames to show you guys more examples of the patterns. And you guys will learn a lot of stuff. Like, let me show you here. I'm gonna scroll up here. You can see some of my traders being silly. But what we do is we'll go into a lot of the things like how trends develop and how they unfold. So how we go from one strategy, what's the next core strategy that's most likely to fall into, how to trade that, what the next one is coming out of that. So you get to see how all of these play together. Oh, thank you. I know I'm told a lot of times, you guys, I don't charge much for the educational stuff I do because I don't make money on my website from you guys. at all. It goes to the tools that I use for managing the website and for paying my admins. I'm happy to back this up. You look at my taxes. I don't make money on you guys at all. My money is made on trading. I have some real estate. I'm not that good at real estate, you guys. I'm glad I didn't rely on real estate. But I don't make money from you. My goal is to help you guys become better traders. And I honestly am a better trader because of it. So if I hadn't started trading and teaching, I don't know if I would still be trading if I wasn't also teaching, because remember that accountability aspect? Yeah. you you kind of got to be accountable if you're going to be teaching. And if something's not working, I want to know why it doesn't work. Some places you'll see people say, oh, well, it just works 80% of the time and 20% of the time it doesn't. Just trade it all the time and you'll be fine. I want to know why it doesn't work 20% of the time. I don't accept that as an answer. So that's what we get into with League of Traders. We really dive into why something is going to be higher risk. So like even that gold trade this afternoon, why there was an early entry that could have just trapped new traders who gave up on it. They might have just given up on it. So why did it have the probability that it would go out twice as long and then try again? That's something that is teachable, you guys. You can learn that, but it takes time. So League of Traders itself is generally just whoosh, information overload for everybody if you just go into that without a background in my systems of technical analysis. But the cores are easy. I didn't come into the markets as somebody from business school or finance. I was an archaeologist and an artist. So about the opposite side of it, but that means I see patterns really, really well. And I come from teachers. My parents were teachers. My dad was the head of the computer engineering lab for the university. My mom was an advanced math teacher. So I come from an education background, so it just helps me solidify things by putting them into words, and you guys get the benefit of that. So thank you guys so much for joining here and attending today's session. I want to give you guys my email address so you can actually contact me if you have any questions. You can reach out to me at help@ToniHansen.com. Let me put this to everybody. And that goes to my support staff, and then they forward all of my personal emails to me as soon as they get them. So if you guys have any questions, send them over there. And I look forward to working with you. I know I've got a number of you in here that I'm already working with. Oh yeah, I don't know who nickname admin is in here. is that But anyways, there's a Trade Tracker Pro on here. It's a Fibonacci fan that can be put on Trade Tracker, you guys. Or sorry, put on NinjaTrader rather. And NinjaTrader doesn't have Fib fans built into it. I'm tripping on my words here. I'm tired, you guys. It doesn't have Fib fans built into it. So this allows you to put those on to your NinjaTrader charts. So really great tool. I know, again, lots of people will charge you that much just for the indicator, but great tool in and of itself. And you guys, you get access to me on Telegram. Let me show you that. Da, da, da. And all of these crazy folks over here too. So Harvey. So you get to see some of our trades, and we'll be up at night chit-chatting. So if you're looking, for some traders to hang out with, it's a great place. So thank you guys for joining me, and I look forward to hearing from you.